Please welcome the panel on The New Age of Private Equity, moderated by business editor at Axios, Dan Primack.
Hello, everybody. Thank you for coming. Thank you for ignoring the other sessions and joining us here today. You made a wonderful, wonderful choice. And I want to thank all my panelists up here to talk about the new age of private equity, which at the moment seems a little bit like the old age of private equity. So I just want to let everybody very briefly introduce yourself, by which I mean your name, where you work, and I don't know, your first job. Eric?
Eric Wilmus. I work at GIC, where I serve as our President of the Americas and run our private equity business in the region. My first job was at Morgan Stanley, working in their capital partners. But
wait, that was your first job?
My first job was working at Stark Packaging, which is a food manufacturing company in my hometown. It was the job that paid $7 an hour, so that was the highest paid wage I could find in town.
I'm Pete Stavros, co-head of Global Private Equity. My first job was doing laundry at a tennis club in town. My first real job, though, was working at the old Salomon Brothers in the mergers department.
Julia Carr from Cinven. First real job was BCG, and first really early job was I was an intern at Sherman and Sterling in college back when I thought that I wanted to be a lawyer.
David Gross, co-managing partner, Bain Capital. First job was working in a hardware store, and then I moved on for my first real job working in Japan for NEC Corporation.
Per Franson, deputy managing partner, EQT. First job was actually stringing tennis rackets at my tennis club, so similar to you, Pete, and then after business school, I started at Morgan Stanley, spent a couple of years there before joining EQT.
So let's talk. It's interesting. 3 months ago at the World Economic Forum, I remember speaking to a senior investment banker who was talking a lot about animal spirits in the deal-making market at the time, right? We were talking the end of January, it was the week of Trump's inauguration. And then he mentioned to me, he said, well, we won't really know anything until Milken. That's when we can actually put all this to the test and see if we're right about all the stuff we're talking about. Pete, let me ask you, I guess, what did everybody in January get wrong?
Well, I guess maybe the premise I disagree with a little bit. I don't think things are that bad. Things are still happening. Credit spreads are up a little bit. Base rates are flat. The stock market's up and down, but overall the market's kind of flat. And things are happening. You know, we've deployed $11 billion across US, Europe, and Asia through April, which is up meaningfully actually versus last year. Now, it was harder to find these deals. They were overwhelmingly, 80% of them were carve-outs and take privates. So you can't just rely on sponsor flow. But if you're proactive and you've got the right sourcing engine, you can still get stuff done. Look, my hope, my wish for our industry is we would get away from reacting so strongly to the news of the day or predicting where the markets are going. That's what's got us in this mess. You know, if you look at what's happened in the last 5 years, 2021 and 2022, GPs massively overdeployed, massively, when the 10-year in the US was 1%. And multiples in the private markets were way higher. And that's got all sorts of implications for the quality of those returns and LP capacity to put money up. So now what we've got is LPs are overexposed to bad vintages, and now many of them are cutting back on what will probably be better vintages. We've got sponsors trying to time the exit market saying, well, now is not the perfect time, so I'm not going to sell. And you know, we need to get out of this mode. And I just wish both GPs and LPs, we would get in a consistent pattern of evenly deploying our funds and our capital over time and evenly returning capital over time, because this boom-bust cycle is creating all sorts of problems.
Julia, I mean, okay, I get this. Up here, I don't even know, I didn't do the math of how much AUM you all represent total. What Pete says makes sense, but it's not what GPs do in practice. Why not? If what he says makes sense, if you agree with it, why do we not see that in practice?
Well, I think there's part of it is just there's all the outside info coming at you, right? About valuations, about peer activity. We're quite a competitive industry in terms of comparing ourselves against each other all the time, right? And so fear of looking like you missed the boat. A bit of groupthink I think tends to happen sometimes with our industry, but also the public markets are cyclical, right? And so you can't dig your head in the sand and say, hey, I've got great assets here, I can sell them when I want to sell them. Unfortunately, the world doesn't work like that. So while that sounds, I love your scenario, and I wish it would make all of our jobs collectively much easier, there are a lot of outside factors outside of our control that make that proposition, more challenging. So I think it's quite hard in practice to achieve that, despite all of us being, and I think all of our collective firms being highly analytical, disciplined, focused on generating great returns. There are a bunch of other outside factors.
I mean, Pete said to me that I maybe overstated the situation. From the outside looking in, and I'm not sitting in all of your boards, in your investment committees, but from the outside looking in, it felt like there was all these processes that were going on in January and February and March. And then, quote, Liberation Day hit, and everything seemed to, if not stop, certainly slow way down. Everyone wanted to take a couple big, deep breaths. The IPO market obviously stopped completely. Am I overstating that when you think, David, or anybody really, when you think of the processes that were very active, whether on the buy side or if you were exiting back in March, am I overstating to say that things seem to take a legitimate pause?
They took a pause, but it was a pause measured in 4 to 5 weeks, and it's the same pause that I think the world took with a pretty unexpected, disruptive set of policies. But you already see it's starting to normalize. I think Peter mentioned in the capital markets, I think there were 10 syndicated loan deals that were priced for LBOs just in the last 10 days, where it was pretty much shut off. I think the private credit market was financing LBOs through the whole period, and you're starting to see sellers selectively take deals that were delayed and think about putting them back in the market. It'll be a bit slower to come back because there's still, I'd say, tremendous uncertainty. But I don't think it's shut off at all. I think it's still on a recovery path from a couple of pretty low years.
Eric, what I would also add to this is that there's some difference also across regions actually. So. We saw a particular slowdown in deal activity in the US, in North America, but in Europe and Asia, I mean, if you were looking at the public stock markets, actually during that time, the volatility was lower, and many were still up year to date compared to where the US stock indices were. So some regional differences as well.
Yeah, I mean, just to echo that, I mean, we saw the same in our business. I mean, in Europe, actually things started very, very slow in January, February, and then they really accelerated. So I think just in terms of people deciding when to pull the trigger to sell, so I think it is quite region specific. The US for sure, I think, just with all of the news and the uncertainty, there was a bit of a pause.
Eric, I'm curious for you, do you feel that the markets, the private equity market back in January, February, even maybe going back to November, December, did they kind of memory hole Trump 1.0 and kind of the chaos of Trump 1.0?
Well, I think there are a couple things that happened. I think the business community was very enthusiastic when Trump was elected. I think there was an expectation that there would be some support for the economy, that and business friendliness that maybe didn't exist previously. I think there was an idea that there would be increased transaction flow and increased IPO activity coming into this year. To your point, there was some of this in the beginning of the year, and definitely mathematically it slowed down. I think philosophically, and I think I've heard it from some of my fellow panelists here, we're long-term investors. We've been investors in the US for 40 years. We opened our first office here 40 years ago, our second office here 39 years ago. And so we've seen so many cycles. So you've seen the dot-com bust, you've seen September 11th, you've seen the GFC. Each one of these times, if you were to say, oh, we're going to pull back from the US because of this thing that we just saw, that would have been a mistake. And so our perspective has continually been to increase our exposure. Even in the last 5 years, we've increased our exposure here from roughly 35 to 40% of the overall portfolio. And so I think that's something that we're committed to long term. Now, were things slower this month? Yes, but practically speaking, do we think this market, has some particular flaw or something that you might turn away from? No. So I think there's a headline here, but I think the longer-term trends remain quite strong.
Can I just ask to follow up on that? I mean, the examples you brought up the dot-com crash, you brought up the GFC. Are you putting this in those categories?
Well, no, that's the irony. I mean, this is nothing like that. So this is a little blip that we can talk about because it's exciting this month, but no, it doesn't compare to those.
Yeah.
I think that this is not that type of cycle, but the cycle that began in 2021 post-COVID is maybe the fourth big super cycle that I think the industry has experienced, right? You had peak velocity at 2-3x the prior year's levels, and then it went down, and now we're in this period where buyers and sellers are dislocated and kind of trying to find the right moment. And so we are in a cycle right now, and I think a lot of the questions that we all have about the normalized level of activity, distributions, which I'm sure we'll talk about, we're still in this kind of low and recovering point of a pretty significant cycle for sure.
I think the point being that there is some cyclicality to private equity as an asset class, and what Pete also was talking about. You just want to take a long-term perspective to everything that you do, right? You have your strategy. In our case, a thematic investment approach. We continue to invest in our local presence, in particular across Asia and Europe, and then we use these type of periods of uncertainty to also unlock opportunities and create really attractive investment opportunities. And that's been the same every time that we've seen downturns in the private equity market.
I mean, one other thing that's long-term right now, though, is this, and David, you kind of started to bring this up, is this distribution drought, right? We have seen basically record low distributions from private equity, true from venture capital as well, for years now. And I feel I have sat on this stage or other stages in this hotel for 3 straight years, and I've heard about this is the year IPOs are coming back. This is the year that we're going to start selling not all, but lots of our portfolio companies. This is the year. And then it always becomes, so you hear that in May, and it's, well, no, it's going to be in the second half of the year. No, it's going to be in the first half of next year. And the can keeps getting kicked. I guess big picture question, because I'm hearing this from LPs a lot. Pete, I'll ask you, I guess, is the private equity model, and you know what, to make everyone happy here, I know all of your firms are long-term and have good returns, so you're all excluded from this. Is the private equity model XU5 broken?
No. So I think there are a couple ways to think about it. What we're talking about here is this cyclical period, and there is no doubt that given the enthusiasm in 21, 22, there was a bit of an overhang in the industry, and I think we're still working through that. I think the bigger question is, what is the secular long-term impact and benefit for the industry? There are a couple things, and some of these are very obvious. It's clear that much of the return in the industry over a long period of time was made from buying assets relatively cheaply and selling them at higher prices. Correlated with that was a period when rates were coming down, so you could finance them quite cheaply. These are 2 huge drivers for returns. People would have different views, but in general, I think the expectation is we're looking at higher rates than we've seen for the last little bit, and probably going to persist at higher levels given inflation. And so you've got 2 other levers to drive returns. You got to buy great companies. Hopefully they're compounders that you can own for a while, and you've got to have a reason that your company has a plan to make some benefit in that business. And so I think if you can do those 2 things, you should have a premium return over public markets in particular. If we look at our portfolio, if we double-click on the underlying portfolio companies, there are thousands of them, you'll see these companies on average have higher growth rates, higher margins, higher return on invested capital than comparable businesses that are trading at comparable prices in the public market. These guys have all spent a long time trying to buy the best businesses, and so that's generally happened. It's a better pool of assets, and so that gives you a bit of an advantage.
If it's a better pool of assets, why have exits slowed so much? When you've got a good asset, that seems to be a thing that people would want to buy from you.
Well, let's come back to that. The second piece of this is the value add. And so this idea that you control a business, and it's existential for any of us, even GIC as an LP, to be able to add value to the companies that you're invested in. You can't drive the returns if you're not able to do that as well. And so you need those 2 things to justify the model. In terms of exits, I think it goes back to the point made previously. Folks bought things at really high prices, including us, in 21. And so there's a lot of waiting for those companies to continue to grow. They're growing well, but continue to grow into those valuations.
Can I disagree with the premise a bit?
Yeah.
So there's a lot of press about distributions being way off, and that's just not what the data says. So what matters to LPs is net contributions. So what are their GPs calling in terms of capital, and what are they receiving back? If you look at 2019 to 2024, deployment grew on a, if you did point to point 5% a year, 5% CAGR. Monetizations grew 5% a year over that same period of time. So it's not like monetizations just
You and I are definitely looking at different numbers, because I'm seeing these DPI numbers that are, in the toilet.
But what does DPI take into account? How much capital has been deployed? So that's the problem. Eric mentioned it, we're all talking about it. It's not that people just suddenly can't sell things. It's that in that 18-month period, we literally went from $600 billion of annual deployment to $1.3 trillion. And the craziness stayed in the first half of 2022. So I do think it's this net problem, which it gets back to, we've just got to get our industry out of this massive procyclicality. And then the question about, is private equity broken? It's kind of like Eric was saying, relative to what? I mean, public markets, 70% of public market trading is automated, passive stuff. There's no fundamental.
And it's done very well over the last couple of years.
Not as well as private equity. Private equity's outperformed. You could pick any time period, private equity has outperformed the public markets, and that's going to continue to happen. When you think about what Eric's saying, we construct our own portfolios, we pick our management teams, we drive value creation, we have alignment mechanisms, we've got better governance. There's just no reason this is going to stop. The idea that private equity is broken, I think, is nonsense.
Well, one more
again,
thing,
I think we've been through these type of periods in the past as well, right? Periods of more challenging exit markets, below average distribution rates. As an industry, we're probably in that type of phase right now. But this will self-correct because LPs will put pressure on GPs to increase their DPIs. I mean,
LPs have been asking for that for years. Now, granted, fundraising has slowed down, but LPs complain a lot. They complain to people like me a lot. They might even complain to people like you a lot. But then ultimately, they don't do a hell of a lot about it. In part because they're not nearly as well paid, and they're terribly organized.
Well, I think it's as simple as if you don't have sufficiently strong DPIs in the current market environment, you're not going to have successful fundraisers, right? So, I mean, managing cash flows on behalf of investors is actually a core capability of any GP.
They do rotate GPs, though, right?
Yeah.
So I think some of the dissonance between the conversation of whether it was overheated and there's not enough liquidity or whether we're okay has to do with the dispersion in the industry. So if you take top quartile and second quartile returns over a long period of time, they've actually been increasing, and they're very, very strong at absolute levels. If you take median returns for private equity, they've been kind of, if you squint, flattish, but maybe coming down in the recent vintages, which means the bottom is in real trouble. And so we can't deny that there was excessive exuberance in the 21-22 period. There was a lot of tech deals done at very high prices. I think we lost as an overall industry, a bit of an anchor on price per unit of growth and portfolio construction, but very disparate results, and you're going to see more of that. So I think through this, private equity won't see its demise, but I think there'll be some rotation of who the key players are and who the players that are not going to make it to their side. And I think LPs, in doing their job in terms of manager selection, they'll fire some managers.
When you talk about finding some new managers, I'm curious if anyone's interested. You're seeing some of these growth equity, a lot of private equity firms moved downstream over the years and got into growth equity, for example, particularly in some of the big tech names, et cetera. You've seen some of those growth equity firms or venture capital firms start to move upstream. Do you think we're going to start to see some of those venture names, the Andreessens of the world, Sequoias, et cetera, who are raising funds that rival the size of your funds, if not larger, start to actually play in private equity?
I mean, it's a pretty different style of investing in terms of the skill set.
But private equity went downstream.
Not down to, I mean, if private equity firms that went down to venture, say, or early growth equity had totally different teams doing that, right? And still those funds paled in size to the size and scale of the large scale private equity. So I question that in terms of, I think it's about picking an idea, picking a TAM versus picking a strategy and an investment thesis and a set of actions and value creation actions that's going to drive the kind of result that you want to see in large-scale private equity, which is quite different from huge TAM, potentially strongest technology. We're going to bet on that. It's quite different.
Is there
But on that topic, I think what we've been seeing is that some of those more early-stage focused funds that they've increasingly also been investing into their active ownership capabilities, right? So that they can also actively drive more value creation, because ultimately, in particular in this environment, that's what LPs are looking for.
But so does that speak to this idea, though, that some of these firms are going to come up and start to challenge you coming from the bottom?
Well, they will try, but I think it's a pretty hard proposition, because of course many of us in the PE business, we've been working and focusing on active ownership strategies, investing into our capabilities, our value creation toolboxes, in-house teams, and so forth. This takes a long time to build up.
Is there, Pete, you talked about the thing you started this idea that the industry kind of has to work through a lot of that 2020, 2021 deal flow, or deals that got done at high valuations. Do you think, does the industry have an appetite to just start cutting bait with some of these? There's what you said, Eric, which is, well, we're just going to wait for them to grow into these valuations. In some cases, the valuations just might have been absurd, and they're not, even if they're strong businesses, they're just not going to grow into those valuations. What do you do with these companies that are sitting there, that are taking your time, that are sitting there keeping capital? What do you do with these things? What does the industry do with that cohort?
Yeah, I can give you our philosophy. Look, we invested in 21 and 22 as well. It's not like we have a view that we're never going to lean in and we're never going to lean out, because we don't know. So it's not like we don't have exposure. Our mindset, just like we want to linearly deploy our funds, say 20% a year, when we've accomplished 80% of what we came to do with the business, we exit. We just do. And if that means it was a 1.5x deal because we totally mistimed it, well, that's what it is. But this idea of we're going to hold longer and time the market, maybe if you're a tiny GP and your only goal in life is to maximize the dollar carry economics and you don't care about IRR, maybe you do that. But for us, we're trying to build a business that lasts forever. So we as I say, linear pacing on the way in and even a deployment on the way out. I do want to say at some point, this is all going to create great opportunity for people who have capital. The ratio of dry powder in the United States relative to assets in the ground in private equity has never been as low as it is right now. It's 40 cents on the dollar. So for every dollar of assets in the ground, we've got 40 cents of dry powder to take it out. All these assets are going to have to find new homes, and there just aren't going to be that many homes to be had. And I think it's going to be a very interesting time to buy.
I might slightly disagree, actually, with what Pete just said, in terms of, I very much agree, we agree with the discipline in terms of driving exits and managing cash flows. But what we're actually trying to do when it comes to portfolio management is trying to find those one or two winners in a fund and trying to stay invested for longer in those. Because if we look at our data historically, they can have an outsized impact on overall fund return if you get it right? And I agree on the point on trying to manage risk, right? But you can also do that with new concepts such as private IPOs, where you diversify the shareholder base and offer some liquidity to existing shareholders while staying invested for longer in those type of businesses.
Yeah, look, if we're bullish on a deal, 80% of what we think we can get done with it might mean we hold it 12 years. It's not saying 5 years and we're out. It's 80% of what we think we can do with it.
Got it.
Eric, can I go back to something when you talk about kind of macroeconomic challenges? There seems to be this weird dichotomy lately where you've got lots and lots of people, particularly on Wall Street and analysts, predicting whether it be severe or not, some sort of economic downturn, recession for the rest of the year. Yet, I'm hearing all of you sound fairly bullish on buying companies. How do I kind of square the circle of the economy and globally? The global economy has, in the US particularly, is going to have some real challenges over the next couple of years, but this moment is when we should be buying while the valuations are still high.
So there are a couple points. Obviously, the GDP data was weak in the first quarter. I think there are still questions around the data, and so we'll see where that gets revised ultimately. If we look at our underlying portfolio companies, the performance continues to be quite strong. So if I look at my IRRs on the portfolio for the last couple of years, they're not as good as I'd like them to be. It's this valuation issue. But if I look at the performance of the companies, the number of our companies hitting their plans is quite high. If we go talk to our CEOs, so quarterly we solicit feedback from 100 of our CEOs. What's going on? How are you feeling about your business? Are things getting better or worse? What's going on with employment, CapEx, et cetera? If you talk to the CEOs, 65% of them think there's going to be a recession in the next year. So to your point, they have that dire feeling. On the flip side, it's a little bit like Lake Wobegon, like everybody's above average. 80% of them believe their business is in good shape and they feel quite confident about it. There's a reason for that, though, and it's not just their own overconfidence bias. It's the portfolio that we own is largely insulated from a lot of the volatility that we see today. It's heavy tech, it's heavy services, it's heavy healthcare. And so we're underweight some of the places, and we do have companies that feel this, that I think are going to be quite exposed if we don't come to a more rationalized tariff regime here over the course of the next couple of quarters.
Can I ask, should there be, do you have, and I don't think most people do, but it happened today, so I'm curious. When I was on the plane here today, the Trump kind of, and he walked it back, but talking about tariffs on foreign-made movies, which is basically a tariff on IP, not on physical product, but on IP, arguably on services. Should there be any unease in private equity when you talk about those things that you feel are kind of defensive when it comes to tariffs, that those things might actually be open to some sort of tariff regime, even though no one quite knows how it might work?
I think as we talked about it before we came in, the tagline for this year should really be, uncertainty is the new certainty. So I don't know the answer to that question. What we try to do is prepare and not predict when it comes to thinking about the portfolio construction. What I will say, just looking at physical goods, we have a big infrastructure business as well. And thus far, transport's been good, our port activity's been quite strong. But if you're looking at forward booking, especially in West Coast ports, it's down dramatically starting this month, frankly.
Yeah.
And so I think there is a question how that's going to hit the economy, how long that's going to last for, and then how it's going to get mitigated.
This session is about private equity, but with the exception, Julie, of your firm, Cinven, none of you work at a pure private equity firm anymore. David, when I think of Bain, Bain started as essentially a venture capital firm that became an LBO firm, which is what it was for decades, and you now have all these other asset classes you are in, both in terms of sector, but also in terms of product. Can you talk to me a little bit about that? Why was private equity not enough? Given the returns everyone's talking about, why was private equity not enough to do?
Yeah, so on the history, we got into the other asset classes back in 97, 98, so we started a debt business and a public equity business. And back then, I think it was actually a view that you could get an information advantage. You'd look at a private equity deal, but it might not be investable, so why don't we go buy the debt? And then you're starting to accumulate vertical knowledge across those areas, and you get some informational leverage. It also actually was an interesting organic talent avenue for our team members who wanted to do something and start entrepreneurially, and we could ensure that if we were starting a new business, it was going to strengthen the core business we had. And so this was kind of an interesting, talent and information strategy. Now with deals becoming so complex, cross-vertical opportunities, we're a global firm, we find that the most interesting and defensible deals come at kind of the intersection of some of these points across asset classes. So, a consumer and a real estate deal. So you're looking at a consumer business which might be under pressure, but might have really interesting, real estate support in that. You need to have capabilities, deep capabilities on both sides of those asset classes. Certainly technology, marrying the early stage with the later stage, whether that's life sciences and big pharma, carving out interesting new molecules that a big pharmaceutical company might have, but how do you stand that up as a startup company? And certainly in technology, where you want to have this view of early stage technology and how that can disrupt or not disrupt something what we might be investing in down the stream. So all this, I think there's a lot of interesting information advantages, synergies, sourcing benefits that you can get if you can get all these kind of businesses working together.
Somebody talked to me about the credit piece of this, which has obviously become a bigger and bigger part of quote-unquote private equity firms. Pete, you guys obviously have a big credit business. What's the reason for why private equity firms should be in credit and should be in it big? And then, Julie, I'm going to ask you the opposite because you guys aren't.
I think David covered it well. We think, and we've got so many examples. We've got deals that have been sourced by our structured equity group, by our credit folks into private equity. So it's been a funnel augmentation effort. I think you got to have the right culture to make this work, so you can't operate in silos. It sounds so easy to execute on this, is super difficult. It comes down to the types of people you hire, how you evaluate them, how you decide whether or not to promote them, how you compensate them. And if you don't really live that type of culture every day, then there is no synergy across asset classes, and there's no reason to do it. And at this point, our filter is really whether or not we see synergy. We turn down lots of new business ideas that bubble up internally, and take our mid-market business. Why would a firm that's we have $650 billion of assets, more than $200 billion of private equity assets, why have a $4.5 billion middle market fund? Who cares? And the only reason we did it is because we genuinely believe it makes our overall private equity platform stronger.
Julia, what's the counter to all of this?
Yeah, well, I've lived in both. I was at a large, diversified.
And we remember your prior answer. So the prior answer has been written down.
Fair. No, and I think the beauty of a sort of the purity and singularity of focus on one asset class and sort of the focus on any individual investment decision and making the right decision for that investment rather than, oh, hey, we're fundraising for this other fund over here and we don't really want to do that in that sector, or hey, we're also totally private and owned by the partners who are at the firm. So we're not worried about, oh, hey, what are public market investors going to think about that or this? And it just, it really drives a focus and a prioritization ultimately on that investment decision and whether or not we can generate the kind of returns that we want to make for our investors on that individual investment. And I find it leads to great investment decision making and great outcomes for our investors. So clearly I'm biased to that model, but I see it in action. I've also lived, and there's scale and some other benefits from being diversified. So I'm not trying to take away from that, but I think there is certainly a place for singularly focused asset managers, in large-scale private equity who are focused on consistently generating, top returns in that asset class.
You mentioned the partners owning the firm. Is there a day-to-day difference, the idea of working at a privately held private equity firm as opposed to a publicly held asset manager?
Look, I think it drives certainly the culture and the collaborative, the sort of low ego, the sort of focus on we're all in it together in our one global fund. And we're organized by global sector teams, and we go after around U.S., Europe together, themes in a sector, and help each other because we're all completely, perfectly aligned. There's real merit to that, and it drives behavior. It drives the way we come across when we're pitching ourselves, to founders, which we do a lot of. That we do, we say, we're going to do, and that we work together very collaboratively, and that we're going to be great stewards for their businesses.
Eric, can I just ask you, curious, on one of the, obviously, sectors, and I mentioned the private credit, there's lots of talk about more deregulation in the U.S. of the financial sector. The private credit market obviously has taken off over the past several years. If there is significant deregulation of Wall Street, does that from your perspective, does that make private credit less attractive, or does that put pressure on these private credit funds that keep raising?
Well, I guess I'd maybe answer a broader question here. So GIC is, I think folks know, is effectively the endowment for a country, for Singapore. So our job is to help pay for bridges and schools and healthcare and support the economic development of the country, as well as have capital that's ready in times of crisis. So think of COVID if you need a fiscal stimulus. That's what the pool of capital is for. And so as we think about this question of diversified asset managers, we're not doing it because there's any particular need to grow our pool of assets. It is what it is. But we are looking for a couple of the free lunches in investing. So one is clearly diversification. And so we believe that being internationally diversified, as well as being diversified across the various products that we're talking about, is of a lot of value to us. And so if we think about private credit, for example, this is an asset class that's developed a lot in the last 10 years. I think it's created a great new tool for corporations, especially, to use to fund their growth that they didn't have before if they could only access a bank or a public debt market. And so I think it's allowed companies to be more dynamic in their growth and development. I can't prognosticate what change in regulation would lead to, but I do know in general it's been good for the U.S. economy. And I do think for a portfolio like ours, it adds another kind of risk that we think has attractive reward. That's been a good part of that overall diversification we're talking about.
Speaking of diversification and multiple asset classes, there was a report today that you guys are in talks or considering buying Arctos. True?
We constantly look at our platform and how we can continue to build it and the gaps that we can fill in it, right? And we fundamentally also continue to believe that this industry will continue to consolidate. So we're constantly talking to market participants, right? And we've also publicly said that we want to grow our solutions business. So we've also had discussions with the Arctos team, with Ian and Doc about potential partnership opportunities. Interestingly, they are, of course, strong in sports. They're strong in the US. We have a strong presence across Asia and Europe. So we've also been comparing notes on a couple of investment opportunities. Yeah, there's no partnership announcement or anything like that imminent.
Nothing imminent. Nothing imminent. Let me totally change subject here a little bit and talk about AI in two different ways. Actually, maybe three different ways. And first, I'm curious, Per, for you, how are you actually applying it inside of EQT?
So, I mean, AI for us is existential, right? I mean, we didn't wake up 2 years ago and decided that this was something we wanted to focus on. We've been working on it for 10 years or so. We have our own in-house AI digital team called Motherbrain. It's a team of 50-plus data scientists and digital experts. They're working hand in hand with the deal teams when it comes to assessing investment opportunities. They're also helping us drive AI literacy and AI adoption across the EQT platform. So, yeah, I mean, in practice, we're applying it in our investment processes. We're giving AI a voice in our IC discussions. We're applying it in our portfolio review processes, making sure that we scrape all the relevant databases to get to the right fact-based outcomes and discussions in those portfolio review processes. And then we're trying to underwrite, repeatable AI-specific use cases for the subsectors that we target.
Over the years, you've been building Motherbrain and working with it. Are there investor tasks? And do you need fewer investors of the humans that you're working hand in hand? Are there things that 5 years ago?
Yeah, I think definitely there's an opportunity to drive more productivity in-house also, but it's not black and white. So what we're trying to do also, really to educate the entire investment professional team on the use of AI, how we best apply it, and to drive AI literacy that way and productivity.
You're nodding your head.
But there's always going to be a human element to business.
You hope so.
Yeah.
So for example, like General Atlantic has an AI now in its investment committee. It can't vote, but it is there. And apparently, if it disagrees with the other people around the IC, they all look at each other like, this might know something we don't know. At what point is there a point that you could see at Bain that AI, if not has a vote, has a much bigger say in what you guys do or don't do?
I'd like to be replaced if possible because focus on some other things. I'm curious to how you guys do it because this is the one that we've still found to be a bit elusive. We've done a lot to try to synthesize all of the knowledge and content and work we've done, internal, external, to have that more at the fingertips of folks. But moving that into a model that can apply that type of nuanced judgment, I think is still something at least we've not been able to figure out how to make that work. The productivity stuff is real, so we've taken our deal process, which is very cumbersome, it's very data intensive, it's very people intensive, and broken it down into tasks and identified which ones could be improved by AI, and there's significant productivity efficiency benefits that we're seeing. Now, I don't think this is not really about reducing our team so much. Maybe we'll be able to scale the team, a little bit less, but it's more about getting the team focused on much more value-added activities, which I would say would be sourcing and relationship building, and that final judgment, two things that I think will ultimately be extremely difficult for AI to replicate. So those are big areas. I think for us, the single biggest transformational area for AI that we're really excited is in value addition, value creation. We've been very, very focused, and we've got a huge value.
In what way? What does that mean?
Well, with our portfolio companies. So literally the next leg of how we're adding value to companies, and this is where in the last 3 or 4 years there was a lot of experimenting about what could work, and now we're seeing some massive gains. And so in the more data-oriented, process-driven businesses take insurance claims, 80-90% personnel reductions, entire functions that are no longer necessary, changing cost structures by not a couple hundred basis points, but 1,000 basis points, 1,500, transforming real business models. And then that becomes an incredibly powerful underwriting tool because you'll say, okay, let's go look for actually brick and mortar companies. It's kind of like when e-commerce started, people wanted to invest in e-commerce companies. They were highly valued. The next wave was to take e-commerce capabilities into sleepier non-tech businesses and transform those businesses. I think we're at that stage now, which is to take that, apply it to change a cost structure of a business, and that in and of itself becomes an investment. That's for us 90% of where we're trying to focus AI right now.
It's interesting. For us, we see not just the sort of cost improvement side of the equation, but just as much also the revenue side and AI enhancement through that. And at some of our tech companies in particular, software companies, we've actually invested heavily in AI-powered product development that has been hugely successful. One of our companies, Archer, for example, is a regulatory compliance software business, and actually, through a combination of organic development and a small acquisition, a tool that constantly is trolling, figuring out what are all the new regulations that have just been implemented, and then pushing that out to all of the client base and saying real time, oop, here you have an issue, here you have an issue, so that they can avoid very significant penalties. So I think, certainly AI can be a huge lever and a repeatable lever that I think collectively we can get conviction behind, hey, we've done this in these X number of other companies, we can do it here with these individual processes from a cost perspective and improve margins. But equally, we can really enhance the revenue line, which ultimately, hopefully that accrues to our benefit for a very long time as that, with that flywheel. And I think that's, just as we think about impact of AI and the opportunity for us as investors who have the benefit of a long time horizon for investment, we see real benefit there.
I wonder, Pete, when you think about, if not your portfolio, Eric, when you think of those companies that you're talking about underlying, it seems that a lot of companies that were invested in, say, 19 or 20 or 21, some of them, particularly maybe on the enterprise software side, have been disrupted, and some of them have applied AI well and have been able to kind of ski that slope, and others have gotten absolutely kind of wiped out by the avalanche. Is that a risk that private equity kind of didn't realize but walked into? In other words, by holding companies longer, they became more susceptible to being disrupted by a brand new technology, and then private equity firms are just kind of holding the bag on them?
I can start. I agree with Per. This is not something people woke up to a handful of years ago. I think people have been focused on this both as a risk and an opportunity for some time. On the new investment side, there's a whole spectrum of risks here. You can have a live entertainment business that's got no real disruption risk and it's just a productivity tool, AI is. Or you could have a content creation company that really could get hurt if you're not careful. So that's kind of the defensive side of it, and the offensive side, I think you guys have given a lot of good examples: outbound marketing, software development, coding. There's tons of opportunity. I think it's still a little bit early. I think in 5 years' time, we'll have lots of these stories that David was talking about of 1,500 basis points of margin uplift. I think those are the true dramatic transformations driven by AI so far are pretty rare. I think we've probably all gotten pitched H&R Block 1,000 times by now. But it's coming. Right now, I'd say it's a defensively, you better be careful what you're buying, and then offensively, it's productivity, cost out, I think some revenue growth, outbound marketing, things like that.
And I would actually, to your challenge or question, I'd flip it around and I'd see the opportunity. In particular, in some of the scale businesses that we have, we see a real opportunity to stay invested for longer in those companies because of AI. You mentioned software as an opportunity. We just a couple of weeks ago announced a private IPO in a business called IFS. 15 billion euro transaction. We raised 5-6 billion euros to provide liquidity to existing investors, including our own funds. The idea behind that transaction is that we're putting AI even more at the core of the software business, and that way we'll be able to create even more value creation and returns by staying invested for longer.
David, you said you wouldn't mind. Oh yeah, Eric.
Just a couple comments. One, I think all of us are working to integrate AI into our businesses, and clearly there are mid-office functions that can be made maybe cheaper, but certainly incredibly more effective. I think of like our audit business, for example. So we get audited, they might audit samples of your work once a year, right? So you got 5% of the information audited annually. a lot of this information is now audited continuously. So if you've got a problem, you find out about it right away, as you find about a year from now. Same thing in our investment processes. You're bringing these tools in to synthesize data, to be able to capture your internal data and external data and improve decision making in a way that's, if anyone spends any time with these models, you'll know they're incredibly effective. So I think that's definitely true. I think the value add for the portfolio companies, I would say I have 5 anecdotes of it. We're working hard with these businesses. I think we're working hard to play defense and offense with the rest of the portfolio. But there are 5 good examples. Like, you can see that this works. And so I think those people will be able to proselytize with other businesses. But for us, the third piece that's really important is, what does this all mean for the investment universe? Because we've got a huge infrastructure portfolio, for example. We own a lot of data centers. We have a huge technology business, early stage technology business, that's investing in LLMs or the businesses that are building software solutions on top of LLMs. All those companies, all that capital that's being spent is only going to get a payback, the payback we hope we're going to get, if all of these anecdotes come to be true. So these things really need to happen to support all the rest of it. So I think that there's a whole ecosystem that works in concert here. Based on what we see so far, I think we're quite optimistic these solutions are real, but that is part of the judgment that's being made across the industry.
David, you talked about how you joked that you wouldn't mind being replaced. But private equity is, at its core, historically at least, has mostly been an apprenticeship business, right? People, and it's not always perfect, and some people kind of come in from industry, but often somebody starts young and they work their way up. And so I'm curious, you said maybe you guys just won't scale in the same way. It would seem, and tell me if I'm wrong, for any of your firms, that at some point, if not already soon, you're going to be hiring fewer young people right out of college or right out of business school. And at some point, that upward flow, there's just going to be less of a pipeline of people. Are your firms, like, who are the partners? Who's the managing partner of Bain in 30 years if you're not hiring as many analysts today?
A robot. We're still hiring lots of analysts. So listen, I think this is about a new division of how we think about the value-added aspects of work. And so if you take that specific example of AI, I think the hardcore analytic pieces, I think how we're leveraging all of our historical data to bring that into a relevant investment decision, that stuff I think is going to change significantly in terms of the percentage of our organization that would be focused on that. But how you then apply that, AI is a enabling technology, but ultimately what has to happen is a business process has to change, a workflow has to change, and that's extremely different industry by industry. And so,
but you don't think that as we progress, when you think of where AI technologies were just a couple of years ago to where they are today, and you think of where they could be in 10 years from now, that those value adds, the stuff that you all bring to your portfolio companies, the advice, the strategy, et cetera, that's not going to be something that can be done with a flip of a switch?
I think it's a massive tool in the arsenal or in your toolkit, but I do think it's extremely nuanced and different in how it's applied to certain industries, and then that's ultimately organizational change. And we're seeing this in this case I referenced, which is an insurance company that does a lot of claims. You can take out a lot of the cost, and you can turn this into a more automated process, but then to make it sustainable over time, productivity or offering service, you've got to change the business process. And that part I'm not sure AI can figure out, although it's moving pretty rapidly. So,
I mean, our business fundamentally is about judgment. It's about making judgments based on information, as much information as we can possibly get.
But isn't that the problem? You, and this isn't an insult to you, this is true for all of us, none of us can process as much information as the AI can.
Right, so more information, so you can use AI as a tool to process more information. That's great. Hopefully we'll all make better decisions as a result, ultimately over time, as we have more and more of that, but we still ultimately are making a judgment based on all of the analysis and all of the data, and then we're making that judgment collectively as an investment committee, as a firm, based on people who have been making investment judgments for a long period of time. So I think that's the piece that I don't see. That's the core of actually, as a private equity firm, what we are doing day to day in every, across the levels. Obviously, the younger folks are doing more of the churning and analyzing, but then from everybody is expected to then have a view, and the folks who are actually analyzing all the data have the closest view, because they've been seeing more of it real time around what does all this tell us. It's never a perfect picture. It's never a simple decision. So here are all the good things, here are the bad things. Ultimately, we come to a judgment about whether the merits, outweigh the challenges.
Eric, can I ask you on the LP side of this? if what they're all saying is correct, there's still going to be a serious role for the investment committee and flesh and blood people, but lots of the back office stuff, lots of the grunt work collar is going to be able to get automated. If I'm an LP, don't I look and go, okay, so the fees go down, right?
I think that I'd go back to the bigger question. I think there's a
You're
question.
dodging that very quickly.
No,
very
it's not that. I think the rate of change in artificial intelligence is incredible. Obviously, the rate of evolution of us is very slow. And so if you're going to take a position that there's some reasonable probability that it's going to outcompete humans in many, many categories, it's a reasonable position. So I might even take the other side of this. It wouldn't surprise me in 20 years if AI were doing all but running some of the best investment houses in the world. So.
I mean,
And how much you pay for it is oftentimes tied to how strong the returns are. I mean, the product we're buying isn't the hours of labor, that's part of it, but the product we're buying is the returns for the portfolio.
the truth is none of us know.
Yeah.
One of the great opportunities in front of a private equity firm, though, is we have hundreds of companies, and we can run more experiments than anyone else in the world. So what our aspiration is, if we own 250 companies, we want every single company to get the best outside thinking they can possibly find, do a holistic audit of what potential applications of AI exist, and run all of those experiments. And if we do it right, we should learn faster than anyone.
I'm going to go, I've got some audience questions, a bunch of them actually sitting here. Thank you to everybody. One final quick question in the news. And this is a fee-related question, but a slightly different one. Julia, I guess I'd start with you. This is a US question, a little bit more, US private equity. If carried interest tax changes, if the preferential treatment for carried interest disappears, which is something that Trump wants and is asking Congress to do, does that change? How does that practically change the U.S. private equity market, investment market, or does it?
Yeah, I mean, look, this is a topic people have been talking about for a long time.
But you now have a president who says he wants to do it, and he's got full control of Congress, and they're passing a tax bill.
Yeah. No, I think it will be detrimental to our business. I mean, I think that's what we've all collectively been arguing for a long time, both in terms of talent, in terms of the way we think about how long we hold our investments. It's going to change decision making, and it's certainly going to change our ability to attract, the best talent. We just talked about how investment judgment and the people and the apprenticeship model, being able to keep people through, a long career. It's a long road, to make partner at a firm. Is it's predicated on those people staying on with the business long term and building those years of experience and judgment. If we're not able to do that, we're a human capital business at the end of the day. That will be detrimental.
Will it change the actual? I mean, Julia said it might change some actual decisions.
I mean, it won't be helpful, but I don't think it also will determine the overall framework that of incentivization, compensation we have, because we've all expanded the tools we have around that. We're huge co-investors in all the deals we do. We have a proprietary balance sheet, which then effectively becomes another source of pretty turbocharged co-investment. Others have public equity. Yep. And so there has been an expansion and diversification of compensation tools and systems, a lot of which is performance-based and kind of, in essence, equity linked. So I think maybe where the industry was 20 years ago would have been actually more detrimental than where it is now.
I'm curious, and I appreciate that your firm's not based in the U.S., but you do a ton of business here and have a lot of people here. Yep. Does it change the way fund documents get written with LPs in terms of, is the 2 and 20, and I know a lot of you aren't actually 2 and 20, but is the 2 and 20, does that disappear? Do the fees become high? I mean, does it change?
I don't see that changing because of the tax regime changing in an important market, because these are global standards, right? And so there might be some other technical changes that might happen as a result. Whether you go to whole fund carry or deal by deal is probably then going to become less important here in the U.S. But I do think it will be important that you have different tools to incentivize your talent and to retain your talent, right? And in that context, I think it's actually helpful to also be able to offer share-based compensation and these things. Yeah.
I'm curious. Eric, I was going to ask, this is an audience question. I was going to ask Eric, but no, Pete, I'm going to ask you instead, because I'm going to ask from the GP side, even though I think it's intended for an LP. This is the question. It says, quote, the private equity model is increasingly criticized as being AUM-driven rather than purely return-driven. What is the best way for LPs to force alignment?
I would argue LPs should just be focused on returns. So if you're a private equity fund inside of a large alternatives company, you better have great returns or you don't deserve the money. I think it's that simple.
Eric, you have a thought? What can LPs actually do to force alignment?
No, I think this is exactly right. We get to vote every 4 years with our capital. And so if a firm is delivering for us, the direct ownership of the firm and the way it's structured is relevant. We think about alignment. Does that impact the way the next fund is going to return? Like, is there something that will create some change in the next fund's performance? But if we feel confident in the underlying investments of the firm, it's not the most important question.
Are we back? You said 4 years. There was a period of time where it seemed like every 18 months or so. Are we actually back to 4 years?
It seems like slower. I mean, as you know, distribution rates are now down in the low teens relative to low 20s. So obviously the average.
Is that easier for LPs? Do LPs feel they have a better, when you say you can vote every 4 years, every 18 months is hard. You don't really know what you're really voting on because you don't really know what, the value of what was done in the last 18 months is just so fresh. Do you think this lets the slower kind of more traditional fundraising period, does that let LPs make better or at least more informed?
Yeah, I think so for sure. And I think it does help firms spread out their own capital and their own risk in the way that Pete was referring to earlier, as opposed to becoming overly concentrated in one vintage.
Pearl, I'll ask this one of you. This is from earlier in the conversation. It says, isn't the point that GPs paid too much on average for deals in 2022 and put too much leverage on the companies that now can't be refinanced because of where rates are?
Well, I think as we've talked about previously, definitely, the post-pandemic vintage is a more tricky one. But also here, back to the points that we've made earlier, the people that stayed more disciplined in terms of their investment pacing, the people that also post-pandemic were able to distribute more cash back to investors, to de-risk fund and lock in performance. I mean, they are in a better shape today, right?
Or they're raising lots of continuation funds.
or they're using various tools in the toolbox to ultimately drive returns for investors. And at the end of the day, what will matter is performance and ultimate outcome on those vintages and those funds. And every 3 to 4 years, as Eric said it, the LPs get the chance to vote.
Can I just get a show of hands from the 4 year? How many of your firms have raised continuation funds for something in the portfolio? Have any of you? You guys have? Help me out here. David, I'll ask you. I'll let Julie. All right, so you raise a continuation fund, and I understand LPs in the prior fund have a chance to either cash in their chips or roll over and stick around. Does the fee structure reset? Do you get to start over?
Not quite. So, there's a change in fee structure. Probably won't go into the exact details of what the changes are, but I think it's settled at a pretty, good equilibrium that still, appropriately rewards the incentives of actually, managing these assets on an ongoing basis for kind of a new chapter, but recognizes the fact that it's not an entirely new, fund apparatus. But listen, I think there are ways, continuation vehicles are really just tools that you can structure the way you want to structure them. They can have high alignment or they can have low alignment based on the types of assets you're putting in there, the criteria you use to choose which ones, go in. We would only put in assets that are not only interesting long-term compounding businesses that we think are quite attractive as big principal investors in our deals, but ones that we actually could sell. In fact, the inverse we would not put in there. Ones we can't sell or fail to sell, we would not put into a continuation fund. But ultimately, the secondary buyers and our LPs, we give them a choice.
Final question from the audience before we have to go. It said, given the scale and maturity of many portfolio companies today, one might expect IPOs to play a more central role in exit strategies, yet the relationship between private equity and public market appears fragmented and underdeveloped. Historically, obviously, private equity typically exits by selling to either strategics or other private equity, but there has been a particular dearth of IPOs over the last couple of years coming out of private equity by historical standards. Just, Julie, I guess I'd ask you, why is it, do you think, that we are seeing so few, particularly in the context of public bull equity markets for several years until the last month and a half of hiccups?
Yeah, look, I mean, it is cyclical, more cyclical than overall equity markets, and I think it's also very specific to the individual assets. And for any asset, you know, Pete talked about this earlier, if you don't have a comp that is a very strong reference point that you can cleanly compare against, or, you know, if you're going out and seeking to be at a significant premium to things that aren't even really comps, right? That creates issues, and then you have a bad execution, and then the next folks that try to IPO after that with a sponsor asset, it becomes more challenging. So I think, you know, some of it's also systemic to, you know, healthcare and anything exposed to R&D funding. Obviously, that's in a cycle. So some of it is also specific to, you know, subsectors and, you know, cycle timing that might be different from overall equity markets. But yes, it is a tool that we all use as an exit mechanism. I think when we think about exits, and we talk a lot about exit as we think about entering and making the investment, we really focus on exit optionality, and we really prioritize availability of cash buyers, whether they be strategic or sponsor, depending on the size and scale of the asset, and, you know, the specific value creation levers that we're going to use to make it more appealing to whatever set of cash buyers we think, you know, we will want to sell to.
Final quick.
Just on that topic, right? I mean, I'd just like to put it a little bit into perspective. Over the last 12 months, we've done 2 multi-billion-dollar IPOs, one in the US, one in Europe. They're up 100%, and we've.
So that would mean you'd
we've
think
had
that
a number
you'd be
of
doing
good
a lot more of them.
Well, all I'm saying is that I think it's an important tool in your exit capabilities. And the better reputation you have among public market investors as a PE firm, the better positioned you'll be also going forward to continue to send cash back to investors.
Final very quick question just down the line. This is overall M&A. Overall M&A for the first 4 months of the year through the end of April globally was up 16%, which is good, not great considering what the baseline is. When the year ends, do you believe we will be higher or lower than 16% up on 2024? Eric, just down the line.
I'd say lower than 16.
Yeah, I would say lower, and I assume the 16% is closed deals. That doesn't really reflect.
It's announced deals.
Announced deals. Really? It's surprising. I would say, I guess it'd be down from there.
Lower, but not that much lower.
Same. Was that a choice?
Sure, it can be a choice.
Feels like puts and takes are on equal side. We have a much better, you know, antitrust system that's coming through here. So I'd say approved deals. I think that's a positive for sure.
Where you get the final say. I mean, it's already decided. It's lower. Sorry, with you.
Yeah. So then, yeah, my best guess would also be
not gonna rock the boat.
Probably. Yeah, I don't have a choice, but probably a lower number. Yeah.
Everybody, thank you very much, and thank you for being here.